I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. When we first wrote about Bitcoin in 2017, and Bitcoin was under 1,000, we had said it could get to 25,000 by 2022 because it's a network value asset. So we just said, if you model number of wallets and activity per wallet, which explained 90% of the move of Bitcoin from 2009 to 2017, you would get to 25,000, 2022, and you can get to the six figures later. And that's true. It's still like 87% explained by those two variables. But Bitcoin is now about to become a lot more useful for two reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset. And companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail. Like that wasn't a thing, but then people realized it was valuable to own the real estate. Like some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. And then, but banks are also quite interested in Bitcoin because of stablecoins.
Back in 2017, when Bitcoin was trading below $1,000, Fundstrat co-founder Tom Lee and his team projected it could hit $25,000 by 2022, based on just two key metrics: the number of wallets and the activity per wallet. Those variables alone explain nearly 90% of Bitcoin's price movement from 2009 to 2017, and they still account for most of the rise today. Quick pause if you're finding value so far. Don't forget to like the video, drop a comment, and subscribe to help this content reach more people. Even simple comments help the algorithm push it further. Now, Tom Lee says Bitcoin is about to become exponentially more useful over the next decade. Regulatory pressure is easing. Bitcoin is increasingly being treated as a strategic reserve asset. Companies are starting to hold it on their balance sheets. Banks are also paying attention, not just to Bitcoin, but to the stablecoin infrastructure being built around it. Stick around until the end as Tom Lee breaks down why this next decade could be the most important stretch in Bitcoin's entire history.
Banks are also quite interested in Bitcoin because of stablecoins. So stablecoins might be the Web3 app that's really recreating financial services because, one, a stablecoin works better than a regular dollar.
You don't have to send it through middlemen to transfer
Yeah,
it.
that's right. Now, if you want to move billions and trillions, you just use the stablecoin market. And it's proving to be more profitable for a bank. Circle, like I won't comment its valuation, but as a net income, or Tether is a better example because it's not public.
How do you trust those Tether people? Like you don't really know what's going on.
Well, that's where, see, this is where blockchain comes in. Blockchain has proven you don't need to know the counterparty. You just have to trust the code. Mm-hmm. And so Tether, from a net income basis, makes more money than most financial institutions. I think would be the third most profitable financial institution in the world.
Wow.
So what's a better bank, right? What's a better financial services model is building it on the blockchain. So I think stablecoins is the killer app that's proving, because Bitcoin anchors everything. Because you don't need a stablecoin unless you had Bitcoin. So Bitcoin and building financial services on top of stablecoins, and financial services companies are getting it now. Even Walmart and Amazon want a stablecoin because it's actually quite profitable to have one. That you are changing the financial system through crypto.
So Bitcoin's not at the top.
Yeah. So if you, again, model this out and utility, because remember, stablecoins is only a $250 billion market today. So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance.
Wow.
So the U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading, 80%. it's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the US. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the US.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
You're a CNBC contributor, as am I. And you have these amazing moments where like you'll show up on Squawk Box and be like, the S&P 500 is going to go up, like 1 or 2% tomorrow? And then it does. How do you know these things?
It's a lot of it is evidence-based because we do a lot of sensitivity analysis to try to understand where we are in markets. So a lot of our statements that we make are high probability statements. But for that to actually happen is luck in a sense, right? Because something that has an 80% chance of happening doesn't prevent this being one of those 20% days that it doesn't happen. So, right, because let's see if something happens 90% of the time and it's happened a million times, but the next 3 times it doesn't happen. So like those 3 calls fail.
The adoption of Bitcoin by governments, institutions, and even mainstream media is a clear sign the world is starting to recognize its value. But according to Tom Lee, this is still just the beginning. Lee is confident that explosive growth is ahead, with firms like BlackRock fully engaged and more capital flowing into the space. He believes the next phase will be unlike anything we've ever seen. After years of research, Lee's data points in one direction. Bitcoin's price follows adoption and activity, and both are now growing faster than ever before.
Statistically, it's still going to stay at 90% for accumulated history. So it is always risky to say something has a 90% chance of happening, but that's usually the reasons we make these kind of calls.
And just quickly, at a very high level. So when you're ready to say, okay, the S&P is going to jump and there's like an 80% chance that's going to happen, what signals are you pulling from? Like you said, you're looking at the sensitivities and different evidence.
Yeah. Well, a lot of times markets make big moves because of surprise. So we have to, like today, we're seeing it today with like Tesla. But the reason there's a surprise is that in a general sense, there's something that, let's say, anchors the valuation of a company. Let's say it's earnings or this S&P. Like, let's say that what anchors it is the Fed's dovish, okay? But then we worry about tariffs and recession. So, like, that's pulling down the market. You can always look for what will counter that argument of recession. And like for us this year, it was the high yield market because high yield spreads need to widen to like 800. The spread over treasuries has to be 800 basis points. So if the 10-year is at 4%, high yield would need to be at 12% to tell you that a recession is almost guaranteed. But high yield during the tariff turmoil only widened by 150 basis points or so, maybe 200, which is just a growth scare, if even. So the reason we stayed bullish into the April low was because high yield said the chance of recession is probably 10%, whereas the economists were saying it was 60, and we could tell by positioning and what stocks were selling off. With the S&P down 25%, has priced in like a 60 or 70% chance of a recession. So that's how we can kind of go on and say the market could make a full recovery because high yield is telling us there's not a recession and it's a better economist than economists. As the market was falling after Tariff Liberation Day, it was falling in a waterfall decline. And so we wrote very early that there have been 12 similar waterfall declines.
What's a waterfall decline?
It's a stock market that falls more than 10% within, I think we did it as a 2-week period. It's really rare to basically like literally cause a plane to drop, 10,000 feet. And almost every waterfall decline is a V-shaped bounce unless there's a recession. So that's why we got so keyed up on this high yield market, because if we fall but we don't have a recession, that just means everyone just panicked. They did a fire-ready aim. And so we argued you would have a V-shaped recovery. And a V-shaped recovery is a symmetric bounce back to the old highs. And of course, everyone argued against it for logical reasons. They said tariffs, they're not going to be solved for a year. The Fed's not your friend. The Fed is going to, there's no liquidity coming like in 2020. So you can't have a bounce. There can't be any fiscal stimulus.
2025, no liquidity.
Well, no, in 2020, the Fed did
that's when they said it. Okay.
Fed did a lot of QE.
Right.
And they're like, there's no QE coming. But we said that history says you have a V-shaped bounce, especially if there's no recession.
Okay.
So that's what made this so hard for people to accept, because the Fed was hawkish and we still had a V-shaped bounce. I think that's the real lesson. I'd say that's really my takeaway from the bounce. And then for this week, there is an old adage that when it comes to war, you sell the buildup into war, but you buy the invasion. Right?
That's a crazy saying.
Or they say you buy when the guns fire, you know what I mean? But that's true. So we were advising our clients that you sell the buildup, but you buy the invasion. So,
why do people buy the invasion? Is it because when the buildup happens, you imagine the worst case scenario and the war doesn't end up in the worst case scenario often?
I think the simple thing is like it's pulling off the Band-Aid. So you're more worried about how painful it is, but when it comes off, nothing's changed.
Well, what if the war is really bad?
Well, so here it was our calculation, which I think maybe people would agree. The U.S. wouldn't take action if they thought it would daisy chain into a prolonged war because there's no appetite. And Trump clearly said he doesn't want to pull us into a war. So if they're taking action, they've either signaled ahead to Iran that this is a limited action, or they know that whatever action they're taking is decisive and limited in scope. So that's why I could see why you would buy the invasion, right? And who knows? There's a lot of signs that maybe we did help indicate to Iran it's limited because, Iran had the trucks and the U.S. was aware of all these trucks moving material, but they didn't stop it. So it was sort of like, look, we don't want to topple the regime necessarily, but this, whatever, we're going to blow this thing up. And I don't know. I'm not a political expert. I'm just saying I can understand why we're rallying today.
In other news, former BitMEX CEO Arthur Hayes has also turned sharply bullish in the short term, signaling that the altcoin super cycle is already underway. After Bitcoin surged past its previous all-time high with strong volume, Hayes said the market has entered a new phase. He no longer sees treasury-related liquidity pressures as a major threat, and his fund Maelstrom is now ramping up crypto exposure across the board. Hayes still sees a chance for a short-term dip, with Bitcoin potentially pulling back to $90,000. But he believes the larger trend is intact. His long-term forecast, Bitcoin hitting $1 million by 2028. Do you agree with Hayes' prediction, or are you more aligned with Tom Lee's long-term outlook? Let me know what you think in the comments below. I read every single one. And while you're here, don't forget to subscribe, and hit that notification bell. It really helps push this video to more people and supports the channel in a big way. Between expanding stablecoin use and looser fiscal policy, Hayes believes the setup for massive price acceleration is already in motion. Really appreciate you watching. Hope this helped you see the bigger picture. See you soon, and take care out there.